Hey everyone, Brian Bogner here, along with the greatest and most awesomest Greg Towner, and it is time for our 5 charts in 5 minutes. Now, this month, we're going to be spending a little more than 5 minutes because, as if you're watching this here in March, middle of March, today's March 15th, 2023. You know that we've been dealing with some banking issues. There have been a lot of concern and worries out there. And so we're going to talk about that. We're going to go through our 5 charts, though, but we'll probably spend a little more time than 5 minutes. So just want to forewarn you as you listen. So, Greg, why don't we get into it? We always start with the S&P 500. It is the 500 largest companies here in the United States, and it's a good place to start. So why don't you take it away?
Yeah, absolutely. I mean, just recently we were feeling pretty good. We broke above that downtrend we've been suffering from for a while. We're kind of settling in above the 200-day moving average. I mean, a lot of things from a technical price perspective you'd like to see. But of course, things don't always go as smoothly as you'd like, right? I mean, the market's always looking out for all these different risks. Everybody's always looking at the same things, but usually it's something that comes out of nowhere that no one's looking at. And that happened again. We just broke down here in the last week below the 200-day moving average. Still staying above the recent low points, though. So I would note that that's key. It does kind of feel like we're breaking down, but technically we haven't fully done that yet. So still kind of hanging in there. But of course, really, this comes back to what's been happening in the banking sector. So, just a real quick review before we dig into this chart. As you may know, a few banks here in the last week basically had to be taken over by the government. Smallish banks, two of them were small, one was bigger but less known. And they had a couple of things in common, Brian, that really is why they met their doom. Uh, and it's an analogy to what can happen to investors. If you don't diversify, right? We always talk about diversification. Seems
Mm-hmm.
pretty simple. Well, these banks didn't do that. A lot of their clients were all in the same industries, speculative ones at that. So they really
Right.
focused on too concentrated. And then the other mistake they made is they stretched for yield.
Right.
Yield is good. We like dividend growth. We like some yields, but you don't stretch for the lower quality or let's get the super highest. They went out too far. They had a mismatch of their assets and their liabilities, and they just stretched their for yield.
Yeah. And Greg, we've been saying for a while about how we believe the economy and the markets are kind of, that the last 10 years things were really stretched and we're kind of coming back to the normal growth there. Well, anytime you do this transition, right? That means we're coming out of some periods where there was some excess, right? There was things that were happening that you would scratch your head and go, wait a minute, this doesn't make sense. And you look at some of these banks and you look how they were investing and what they were investing in, and what they were doing was highly speculative, and that created a lot of excess. And so, sure enough, as we revert to the mean, as things kind of come down, right? When you're leveraged up, or you're not diversified, or you're in some very speculative things, the tide goes out, and you're caught, and you're in the situation you're in. Now, what's happened here, though, right? We've had a few smaller players get affected by this, but it's brought the entire banking industry down.
Right.
Okay, and this is just showing you it's oversold, meaning it brought the whole banking. I mean, even more so than back during the COVID sell off. So it's been a pretty hard sell off in banks, but again, we're just right at this point right now. It's just been a few that have been affected by it.
Yeah, and in the bigger, higher quality ones like that, unfortunately we own, they've been affected. The stock prices haven't been
Right.
immune, but they're probably going to benefit from this from a fundamental perspective,
Right.
gather more deposits, and I think it's inevitable there will be more banks that go under, but they'll probably get less and less headlines as this goes along. And if we
Right.
look back, Brian, all the way to the savings and loan crisis, this
Yeah.
predates even our careers back to mid '80s,
Hmm.
early '90s. More than 30% of those financial institutions failed. I
Yeah.
mean, that must have been a horrible time for the market, right?
Right.
Well, no, the stock market doubled during that period,
Right.
despite all these financial institutions failing. So, I mean, we don't know how this is going to play out, of course, but just don't assume that some banks going under, things are going to go terrible. Because, I mean, the government has stepped in and guaranteed all deposits. They haven't said for sure they will do that for future ones, but they've kind of implied that.
Right.
So,
Right.
uh, banks are oversold here. So,
Yeah.
what has this done to financial markets? I mean, of course, it's affected the stock market. We showed that on the first slide. The bigger aspect has been in interest rates. This is a 2-year yield. We showed this because it's kind of tied to what the Fed is doing usually. Had a huge spike in recent weeks and months, all the way up to 5%. It looked pretty attractive, frankly, at that point. And clearly, the market has started buying this for two reasons. Number one, just a flight to quality, like, oh, my money's not safe at some banks. Oh my gosh, let me own some treasury bonds. So that pushed the yield down. But then also, Fed expectations now. We thought just a week or two ago the Fed was going to keep raising rates quite a bit, to knock down inflation. Well, now the assumption is that they're going to slow their increases, maybe even pause them in the near future. They have a meeting next week. So yields have come down from 5% on the 2 year to now this morning about 3.8,
Wow.
3.85 around there. A big move in yields.
Yeah.
Well, I mentioned the Fed, I mentioned inflation. We talk about it every time. We did have another consumer price index number come out here recently. It ticked down lower again, not as much as we'd like to see, not as much as the Fed would like to see. It continues to be shelters dragging. We did have another number early this morning, PPI, come in. That was really soft on inflation, so that was a good sign. But it's still kind of inching its way down, not as fast as we'd like, and this kind of puts the Fed in a little bit of a tough spot. I
Hmm.
think they would want to keep raising rates to, to crush inflation,
Right.
but with what's going on with the banking, they're probably going to back off a little bit. So
Yeah.
it admittedly puts them in a little bit of a spot, and it's going to be interesting to see how they play out with this. It's not easy for them to figure,
Right.
and a lot of people are trying to guess what they will do. Brian, this has gone from one of my least favorite charts to one of my absolute favorite. So, any of us in the business have seen these charts, a lot of variations of it over time. So, what this says is from 2003 through the end of this last year. What did the market do? The last column on the left there basically earned about 10% if you're in fully invested that during that time. But then it says, well, what if you missed the 10 best days? Well, you got about half of that return. What if you missed the 20 best days? And they got 3% and so forth. And I always thought, well, that's just silly. I mean, who's going to just happen to miss those best days? But, the more I thought about it, and then reading this kind of inset box there, this made more sense. It says 7 of the 10 best days occurred within 2 weeks of the 10 worst,
Yeah.
and that 6 of the 7 best days occurred after worst days. So think about it. We've seen throughout our career, you can go back just a few years to the COVID lows, people panicking at
Mhm.
bad times for the market when those worst days are occurring. Inevitably, because they bail out, they miss those best days. So hence,
Right.
what they're missing out on for this chart. So that it kind of dawned on me like, hey, a lot of what we talk about from the emotional side is
Yeah.
tied into this chart.
Yeah.
And it's just dangerous for investors to be, trying to time things, try to get in and out all the time. It goes back to what we've been talking about recently with dollar cost averaging. We think this is a
Right.
great time to be dollar cost averaging into this market. And I think that chart helps emphasize that.
Absolutely. Absolutely. Without a doubt. So, in closing here, as we said earlier, we think that right now it's just been a few banks. The mainstream bigger banks have not shown signs of stress. If anything, this could be an opportunity and a tailwind for them right now. But again, they've not shown any signs of stress. It's just been some of these banks that have really been more speculative and not diversified. The Fed could possibly be nearing the end of their rate hikes here, which would be a positive thing because now cost of funds wouldn't keep going higher. But on maybe on the negative side, there's a cautionary sentiment right now. When I talk to business owners, they're busy and business is going well, but they're just scratching their head like, I don't know, should I hire some more people? Should I make a capital investment? This and that. I don't know. There's so much uncertainty right now. Banks, sure enough, after this thing, they're probably clamping down on some of their lending requirements and things like that. So it might be a little bit harder to get money. So there's still this cautionary sentiment that's out there as well that we need to watch. But we've been saying this for a while now. Okay, the next 10 years are not going to look like the last 10. Okay, so whatever you are thinking over the last 10, and we do this, we have this like recency bias where we assume that, well, this is the way things are going and it's the way they're going to continue to go. You've got to have an open mind. We've been saying this for a while. The next 10 years are going to look very different. And as we transition, right, which we're in this process of transitioning right now, there's going to be some bumps. And this banking issue that we're going through right now is a great example of it. And that's why it's important. You need to have a disciplined plan and you need to stick to it. If you don't have a disciplined plan, give us a call, talk to us. We'll be happy to help you put a plan together And not only that, once we help you do that, create that plan, we're going to help you stick to it. Okay. So thanks so much for watching. As always, you know where to reach us. You know how to get a hold of us. We really appreciate your time today, and we'll talk to you later. Thanks.